In 2007, Warren Buffett pulled out $1 million and made a bet with all of Wall Street. The bet was simple. Wall Street could pick any actively managed funds it wanted. Buffett would buy one thing and one thing only: a plain, boring S&P 500 index fund that just tracks America's 500 biggest companies, and then sit on his hands and do absolutely nothing for 10 years. Whoever had the higher return at the end would win. Ted Seides, a partner at Protégé Partners, one of the top hedge fund shops of the era, took him up on it. Over the previous 5 years, his team had racked up a cumulative 95% return, crushing the S&P. So as far as Ted was concerned, Buffett had to be out of his mind to offer a bet like this. 2007 was also the absolute peak of the bull market, with the shadow of the subprime crisis already creeping in. And in a financial storm, hedge funds, the masters of shorting and arbitrage, are exactly the players who tend to shine. Choosing to buy an index fund and just lie there motionless? That was like booking a first-class ticket on the Titanic after you'd already seen the iceberg, with no steer on hand. $1 million was pocket change to both Buffett and Ted, but hey, who doesn't like free cash? Ted picked 5 funds of funds to send into battle. Behind those 5 funds sat more than 200 elite hedge funds. And these managers weren't your local financial advisor. They pulled the highest salaries on Wall Street and wielded the most sophisticated quant models, macro hedges, and arbitrage strategies money could buy. The special forces of finance. The specific funds were kept confidential to stop rivals from copying their strategies, though most people assumed Protégé's own fund of funds was one of the 5.
Wall Street mobilized instantly. Kalman filters and Hawkes processes, decomposing order flow imbalance on the book, copulas and manifold learning remodeling global tail dependencies to hunt cross-default cascade traps across equities, credit, and commodities, while the HFT desk ran dark pool latency arbitrage pipelines and the macro team fed satellite scrape port throughput and Walmart parking lot density into alt-factor ML models, calibrated T-48 hours for one asymmetric information edge.
Then the risk desk stress tested it through Monte Carlo regime switching scenarios, hedged the residual Greeks with variance swap overlays, and let the Ornstein-Uhlenbeck mean reversion signal trigger the execution, net neutral, fully.
In 2012, Buffett celebrated the Spring Festival with his Chinese fans singing the classic American folk song, "I've Been Working on the Railroad." A lifelong train enthusiast, he had spent year 2 of his bet closing one of the largest acquisitions in Berkshire's history, the BNSF Railway. A train can't swerve or take shortcuts. It just trundles along, but it always gets there. Over the next few years, he just kept goofing off, trying his hand as a jewelry salesman, showing off his childhood paper route throwing form, playing table tennis against a professional player. Warren, you really think you've got a shot as a layman against a pro? He did. Even though the bet started at very nearly the highest point before the worst financial crisis since 1929, Buffett still pulled an annualized 8.5%. Just buying and holding got him squarely into that 8 to 10% range that stocks have delivered over the long run. So, how badly did Ted beat him? Wait, what? Not a single one of the 5 funds of funds beat the index? The average return was a measly 3%. The worst one annualized 0.3%. You'd have done better leaving it in a savings account. If they hadn't thrown in the towel and liquidated early, the number might have gone negative. To this day, the fund's details remain confidential. Except now, it's not because they're afraid of being copied, it's because they're embarrassed. Buffett didn't much care whether they were disclosed. As he put it, "I'm not trying to prove that any one specific hedge fund manager is an idiot. I'm trying to prove that the entire system, sky-high fees and constant active trading, is structurally incapable of beating the long-run compounding of a country that just keeps growing." And this wasn't some hindsight. In his 1993 letter to shareholders, that's 14 years before the bet, Buffett wrote, "By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals." In 1996, he hammered it home again. For the vast majority of investors, the smartest, most worry-free move is to hold a low-cost S&P 500 index fund. And when the bet was 6 years in, he went so far as to publicly reveal his own will. After he dies, 90% of the trust he leaves his wife will go straight into a low-cost S&P 500 index fund. But what on earth happened here? Ted Seides had such a dazzling track record. Was he just unlucky for 10 straight years? How can the most elite financial minds on the planet fail to beat a simple index? The whole thing is so absurd that a reasonable person would just write it off as a fluke, a publicity stunt. So where did Buffett get the nerve to be certain he'd win? Because compared to Ted's brief winning streak, Buffett had something far more powerful in his back pocket: data and principles that go much deeper. In this video, I'm going to expose one of the greatest cons in the history of human finance: actively managed funds.
Most investors don't believe that markets are efficient, so I don't.
In the very same year, Buffett made his bet with Wall Street. Nobel laureate Eugene Fama and his colleague Kenneth French conducted a comprehensive analysis of every actively managed equity fund in America over the 23 years from 1984 to 2006. Using computer models, they stripped out beta, the risk premium that drives the market upward over time, in an attempt to fully isolate alpha, the excess return a manager earns purely through skill. Way back in 1968, Michael Jensen, the man who invented the concept of alpha, laid out a now famous null hypothesis. If a manager has zero genuine forecasting ability, then once you remove the risk premium of market volatility, beta, the statistical expectation of alpha, the number that's supposed to represent the manager's skill, should be exactly zero. If alpha equals zero, every penny the manager made came purely from taking on the corresponding market risk. Their stock selection and constant trading added no value to the fund. If alpha greater than zero, the manager either got lucky or they really are a genius, earning a pure skill premium beyond what the market's risk paid them. And if they're alpha less than zero, they either got unlucky or they systematically underperformed the market. Fama and French used an innovative technique called bootstrapping. They took the real historical returns of thousands of funds, removed the alpha, then shuffled and recombined the data like a deck of cards, tens of thousands of times, to generate a random distribution curve representing pure luck. Then they laid the manager's actual return curve on top of this luck curve to see how they compared. Surely these untouchable Wall Street elites pulling 8-figure salaries wouldn't end up tied with a coin flip, would they? The good news? The final results overturned the hypothesis. The curves didn't overlap. The real return curve was clearly skewed. The bad news? It skewed to the wrong side. The actual return curve didn't sit to the right, it shifted unmistakably to the left, into negative return territory. In other words, after deducting their fat management fees, commissions, and expert salaries, these managers, some of the brightest people on earth, performed meaningfully worse than a coin flip over a grueling 23-year contest. The vast majority of managers had a negative alpha. Even before accounting for trading costs and expert fees, their alpha still barely scraped zero, frequently dipping below it. Once those hefty expenses were dragged into the equation, their performance fell off a cliff. So we were paying these people top dollar, essentially, to watch professionals flip coins. 23 years of American mutual fund history collapsed into one giant punchline. The managers used their exquisite professional skill to flawlessly underperform random chance. S&P Dow Jones Indices, the very company behind the S&P 500 that Buffett bet on, publishes something called SPIVA every year. The name says it all: S&P indices versus active. So index funds versus active funds, head to head. This data is the industry's single biggest taboo, the thing managers will do anything to avoid discussing, which is exactly why almost nobody knows about it. And the truth will be destructive to your financial worldview. In the US, nearly 80% of active funds underperform the S&P 500 in any given year. Stretch that to 10 years, and the share of American equity funds losing to the market hits an absolutely staggering 93%. Even the best-performing fund category has an underperformance rate of more than 80% over 10 years. And America is not the exception. In Europe, most active funds also lose to the index in year one. Almost 90% of Eurozone equity funds fall behind within a single year. When extended to 10 years, the underperformance rate approaches 100%. Outside of Switzerland, every European country posts a 10-year underperformance rate above 90%. Swiss funds manage the continent's best score at 84%, losing with such dignity, truly befitting a nation built on finance. Japan, amazingly, has a fund category with a 100% underperformance rate. Even emerging markets follow a similar pattern. For the longest time, finance academics believed that at least in less mature markets, managers could scoop up some easy wins. Take Brazilian large-cap funds. Maybe out of sheer luck, they really did show off active management's edge in the short run with a one-year underperformance rate of just 35%. This was the closest any fund category has ever come to beating a coin flip. But if you stretch it out to 10 years, the rate still exceeds 80%. And zooming out, emerging market equity funds issued in Europe also clock a 10-year underperformance rate of around 90%. In the face of time, the active management halo always fades, though in the vast majority of cases, there was never a halo to begin with. Plenty of shadow instead. Now somebody's bound to push back. But it's not like every single fund underperforms, is it? Some of these funds did beat the market over 10 years. I'm not investing blindly here. I'm obviously going to pick the best active funds, ideally the ones with a track record of winning year after year. And if active funds do better in the short term, doesn't that prove they can beat the market under the right conditions? Well, bear with me. Let me give you a perfect analogy for this. The best way to illustrate this is with coins flipping. First of all, if enough people flip coins, someone is bound to hit a long, lucky streak of heads. So, how do we figure out whether those flippers on a hot streak possess some excellent coin flipping skill or just got incredibly lucky? One way is to check whether the proportion of winners matches a random distribution. Eugene Fama already proved that active funds' excess return, alpha, follows, or actually lags behind, a random distribution. This means the entire positive alpha segment is fully explained by pure luck. If you're good at statistics, you get what I'm saying. But that might be a bit too abstract for many folks. So here's a more intuitive approach. Isolate all those elite coin flippers and have them flip for a few more rounds alongside a randomly chosen group. If, in those next rounds, they hit heads at the exact same rate as everyone else, then their earlier miracle was nothing but luck. In statistics, this is called an out-of-sample test. Think about it. It's easy to look like a genius on a single coin toss. You've got a 50-50 shot right out of the gate. And that's exactly why one-year fund underperformance rates look better than 10-year ones. It's not that managers are wizards at short-term trading. It's just that not enough time has passed to expose them. Though, honestly, I'd argue their one-year return results are way worse than a 50-50 coin toss. We can apply a similar out-of-sample test to active funds. These gray dots in the center of your screen represent a real sample of 1,833 active funds in the US back in 2015. Since fund returns aren't binary like a coin's heads or tails, we can rank them by performance. Over the 5-year period from 2015 to 2020, we select the top quartile, the 458 best performers, and the bottom quartile, the 458 worst performers. If managers with genuine skill actually exist, then over the next 5 years, 2020 to 2025, those elite funds should beat the median at a much higher rate than the bottom quartile dogs. If both groups have roughly the same win rate, it proves the earlier performance was pure randomness. And the jaw-dropping result? Whether a fund was an honor student or a class flunk-out, its probability of beating the median in the second 5 years was a pathetic 28% for both groups. It gets worse. If we look at funds that landed in the bottom quartile or were liquidated entirely, the elite group saw 41% of its funds end up in the dumpster. The bottom group? just 28%. Ironically, the bottom group's number actually makes statistical sense. So, the winning funds are in even rougher shape than they look. A mountain of academic literature shows that previously top-performing funds are more likely to subsequently underperform for 3 reasons. First, size is the enemy of performance. Both the famous Burke and Green model and empirical data show that when investors pile into a hot fund, its assets balloon. This creates severe diseconomies of scale. For one thing, deploying enormous sums incurs massive market impact costs. And for another, the manager simply can't find that many great stocks, forcing them to buy second-rate assets. Second, strategy crowding. When a tidal wave of money chases the same handful of star funds, giant pools of capital all pour into the same crowded positions. In the short term, this flow-driven pressure drives prices to irrational highs, manufacturing the illusion of consistency. But over the long run, it leaves assets badly overvalued. The moment the inflows dry up, you get a brutal reversion to the mean. Third, star talent flight. Once a top manager makes a name for themselves, they tend to strike out on their own to launch a private hedge fund, and the original fund loses its edge. But beyond all these, there's an even more fundamental principle behind why managers can't beat the market. Picture this: you're stuck in traffic. You're probably cursing as you yank the wheel, lane hopping and cutting people off, only for fate to mock you every single time. The instant you switch into a new lane, it slows to a crawl, and the lane you just left starts moving, over and over again, until finally that white sedan, the one that had been sitting patiently behind you the whole time, cruises right past you, still sitting comfortably in your original lane. There's actual logic behind this. The moment one lane looks slightly clearer, drivers swarm into it to grab the gap. This herd behavior repeats endlessly, and the end result is that every lane moves at basically the same speed. Research from the Federal Highway Administration shows that frequent lane changing in heavy traffic delivers no real benefit. It doubles the accident rate and triggers serious cognitive fatigue. You might shave about 2 minutes off a 90-minute drive if you're lucky. That's before you count the wear on your gas and brake pads. And more importantly, all that weaving badly drags down the cars behind you, making it one of the leading causes of traffic jams in the first place. This is exactly the logic of investing in active funds. Those skilled managers are just like drivers desperate to change lanes. Their constant churning of positions, chasing whichever sector is hot, is just lane changing in the financial market. But the friction costs of frequent trading and the steep management fees are like gas and brake pad wear, relentlessly eating away at the excess returns that probably don't even exist. And it's crueler than that. The market is crawling with too many smart speculators, so the moment one lane, a stock or a sector, starts showing a profit, money floods in and jams the lane almost instantly, sometimes even making it slower than the rest. Worse still, investors who load up on a single stock chasing big returns sometimes end up in a catastrophic blow-up, a financial rear-end collision. The market isn't stupid. Whatever opportunity you spotted, someone else was already staring at it. The market today is wildly oversaturated with speculation. So oversaturated that even Wall Street's top traders usually can't beat the benchmark index. That's why Buffett keeps advising ordinary investors to just stick with passively managed index funds. In academia, this phenomenon, where every lane moves at about the same speed and changing lanes just burns gas to get nowhere, is called the efficient market hypothesis. The EMH comes in 3 forms, 2 of which are widely embraced by the academic community. They demolish retail-grade technical and fundamental analysis, respectively. That's a story for future videos. But the sharpest viewers may have spotted a contradiction. Hang on, if lane switching never works, then who's actually filling the fast lane in the first place? Someone has to successfully cut in before everyone else catches on, or the lanes would never rebalance at all. You can't claim that switching lanes is pointless and that the lanes magically stay balanced at the same time. Great point, but you're forgetting human nature. Whether managers can beat the market is determined by their ability. Whether they want to is determined by their incentive. A star manager typically runs two completely different kinds of funds at the same time. One consists of mutual funds for ordinary retail investors, charging just a fixed 1 to 2% management fee. The other consists of private funds for a select group of high net worth individuals, where the manager typically pockets a performance fee of around 20% of the gains. In the industry, this is known as side-by-side management. So, if a manager sniffs out a top-tier opportunity with a sky-high win rate and obscene profit potential, what does a rational person do? No matter how much the mutual fund makes, the manager doesn't get a slice of the upside. They're just working for a flat fee. But with the private fund, every dollar of profit means they personally walk away with 20%. The conclusion writes itself. Faced with that enormous temptation, the manager doesn't hesitate to cherry-pick. They feed the very best trade ideas to their own private funds and proprietary book first. Only once the juice has nearly been squeezed out do they finally open the gates for retail investors' bloated mutual funds to pile in. And sometimes it's entirely by design. Bringing that flood of retail money in can itself be the strategy. Use it to prop up the proprietary book, pump the price a little more, then quietly unload. In the industry, this is a textbook conflict of interest and a dirty form of front-running. So those cars that successfully cut into the fast lane, they exist. They're just definitely not the ones you're driving. You're stuck breathing their exhaust and sitting in the gridlock their lane cutting caused. Think this is just a made-up conspiracy theory? Nope. Academia proved it years ago. A 2018 paper in the top-tier Journal of Financial and Quantitative Analysis, JFQA, conducted a rigorous empirical analysis of exactly this side-by-side management. The finding? Whenever a manager runs a mutual fund while also holding a performance fee-earning private hedge account on the side, the performance of their mutual fund suffers an average drag of 1.15% per year. Back to our original bet. The reason Buffett dared to take on all of Wall Street is that he'd long since seen through the most ironic and brutal bedrock logic of financial markets. In the game of investing, unless you've got inside information or an elite-level infrastructure and team, the harder you try, the more ground you usually lose. This might sound bleak. If professional institutions with the most advanced quant models and the core informational edge can't even reliably beat the market, what hope do the rest of us have? The answer is almost unbelievably simple. Admit your own ignorance. As Buffett said, the moment you acknowledge your ignorance, you're no longer ignorant. The efficient market hypothesis, which we'll dive into in future videos, is built exactly on this. How to master the rarest and most valuable skill in the entire stock market, admitting what you don't know. Pull that off, and you can outperform the overwhelming majority of professional investors. This video is just one part of a much larger project about a single investing rule. For the retail investor, the simplest investment strategy is actually the optimal one. The moment you have idle cash, immediately invest the full amount into a broad market index fund, no market timing, and hold it long term, withdrawing only the exact amount you need. I've packed this entire strategy into a catchy acronym, the BLA rule. Broad index, lump sum, anytime, hold. In English, when you quote someone who's rambling on with nothing but filler, you abbreviate it as blah blah blah. And that dovetails perfectly with this rule. As retail investors, you don't need all that noise. No technical analysis, no sector rotation. Cut the nonsense, just blah it. This video covers the index part of the rule. Over the course of future videos, I am going to ultimately prove that this seemingly dumb strategy is far more robust than you ever thought possible.